In this week's video, we'll review the latest charts, studies, data sets, and scores to help us answer the question: will a failed stock market rally be followed by much lower lows? We'll be moving quickly, so feel free to use the pause button on your video player. We'll begin with charts from June 3rd, and then we'll shift gears to a segment of the video that was recorded Thursday evening. And keep in mind, during Thursday's session, the S&P 500 was up 75 points. There's no need to re-record this session, but it should be noted: the purpose of using scores, models, charts, and studies is to try to help us maintain our objectivity even after the market is up 75 points. It's very, very easy to have a bullish bias when you get a really, really strong session. We want to maintain a balanced approach. And then we'll finish up with some comments from Friday's session. So Dow Jones Composite Index intraday on June 3rd, approximately 1 p.m. Eastern Time. We covered this chart last week. This week, not a lot of change. For the week, as of this recording, it was down 0.4% for the week. So relative to the commentary from last week, filled this easy white space here. This week, we're in the secondary easy white space here. So this move here is easier than this move here. But if we're going to try to maintain a move into this area here, as we noted last week, it gets even harder. Similar situation here with the broad NYSE composite. We moved above and through the easy white space, and this week we've been pinballing around the secondary white space up here that has a little bit more resistance, but it's still relatively easy compared to this up here. Same situation here. Since last week's video, not a ton of movement. Intraday on Friday, NYSE Composite was down 0.43% for the week. So all of the commentary from last week's video, you can find it here, still applies relative to these charts, including the potential for significant downside if we can't hold these levels up here, and that's to be determined. Now let's flip over to the Thursday session, and keep in mind, objectivity is the key here. If we look at both bullish and bearish scenarios, it's much easier to keep that flexible, unbiased, and open mind. This is the 2022 daily DeMark chart that we've covered in previous videos. To refresh your memory, the 9 paired with a 13 tells us there's a higher probability of a trend reversal. And as we've noted in previous years, typically the 9 and 13, when it turns out to be a good signal, is paired with some type of pivot from policymakers. Similar situation in the 2016 case. You have your 9 paired with the 13, and that was paired with a dovish pivot. 2018 case, we didn't have the 9 and 13, but soon thereafter, 5 to 6 trading days after the low, the Fed did indeed pivot. COVID low, 9 paired with the 13, and a major, significant pivot from the Fed. Still unclear in the present day whether or not the Fed has indeed pivoted in a meaningful way. And ultimately, like anything else in the markets, that's for the market to determine. And if the market believes the Fed has pivoted in a meaningful way, or something has changed in a meaningful way, we know with 100% certainty the downtrends that we're currently in will eventually flip back over to uptrends. You might remember last week we covered the 3 previous instances where we had NYSE 80% up days back to back to back. And in those cases, S&P 500 returns walking forward and NASDAQ 100 returns looking out 1 to 2 years were excellent. On the left side of your screen is an expanded list of those dates going all the way back to 1968. Source of the data right here where my cursor is. This is the Twitter handle. And as you might imagine, if you run the numbers on these cases over here based on the back-to-back-to-back 80% up days, in most cases the outcomes are extremely satisfying. 1 year later, the average gain was 22.4%. The median gain was 25%. But it wasn't 100% smooth sailing in all cases. In the 1980 case, there was a very significant drawdown after the third 80% up days, 17.38%. And the back-to-back-to-back 80% up days that ended on January 2nd, 2009, the market had to take another leg down, a very painful leg down. From this date here to the low on March 9th of 2009, the additional loss in the S&P 500 was 27.4%. Looking at all of these cases, the average loss or drawdown after the signal was roughly 6%, the median much better, at a relatively muted 2%. Now the back-to-back-to-back 80% up days, that's a form of a breath thrust. And in recent years, breath thrusts have been highly reliable, really not so since the beginning of the year. Thus, we took a closer look at these cases here and focused on this shorter subset here on the right side of your screen. If you look at some of these cases here that we've eliminated, they really don't look enough like the present day to be relevant. In the cases that were most similar to 2022, how do the drawdowns look? On an average and median basis, no real significant change. But the takeaway is, in the similar cases, for the most part, any backtracking would hold near the recent lows, and that's very, very helpful. So it's telling us that in most of these cases, with the exception of this case here, January 2nd, 2009, any retest of the prior low held, at least conceptually when we apply it to the present day. It's very, very difficult to ignore this case here because the S&P 500 hypothetically, if we experienced a similar drawdown from the date of this signal in 2022, would backtrack all the way in the neighborhood of 3,000 down here and all the way back to levels last seen in June and July of 2020, and we would undercut the high here prior to the COVID plunge. As always, all hypothetical, simply speaks to probabilities. Thus, in the present day, if we can hold these lows here, it increases the odds that we'll see something good going forward. But if we can't hold these lows here, and the longer we stay below them, the higher the probability that we're looking at one of the less satisfying cases. Thus, when we look at all of the cases, there's no question, for the most part, it tends to be a very, very bullish signal, but it's not infallible. In two of the cases, buying on the date of the signal turned out to be very, very painful. Thus, focusing in on the cases, historical cases that are most relevant and most similar to the present day, we wanted to try to develop a scoring system to help us understand, does it look more like one of the successful cases, or does it look more like a failed case? And much like the bird strike tools that we added to our toolkit after the plunge in 2018, this is a special situation model. It'll be used in conjunction with the market model from time to time when it applies. Let's focus in on this case here. October 6th of 2011 is one of our back-to-back-to-back 80% up days, which is this day right here. So this is a form of a breath thrust here. Occurs over 3 trading days. You can see on the right side of the chart here, really good things did happen in this case. Thus, from a trend perspective, it might be helpful to try to discern between these failed rally attempts over here on the left side of this major low and this rally attempt that turned out to be successful. So anecdotally, just showing a small example of the concepts used in the new scoring system, you can see over here on this rally attempt, price fails at this downward sloping 47-day moving average here shown in pink. It's a subtle difference, but the trend is stronger over here. How can that be? Well, we have a period of consolidation over here. Typically, some form of consolidation improves the probability of a trend reversal. So in this case, right after the date of this signal, we clear a hurdle here that we couldn't clear in these cases that ended up failing. Can't close above the 47-day moving average here, and the 47-day moving average never turns up before the low. Not true after the low. The slope of the pink 47 is turning up right here. Nothing magical about any of this. Speaks to probabilities. So in the present day, If we're going to get a successful rally and a major low is in, eventually the present day chart will morph back into something more like the left side of the screen over here and or the right side of the screen over here. As we've mentioned in the past, this is a full bore bullish look with blue, the fastest moving average, the 8-day moving average in this case on top, and teal, the slowest moving average on the bottom, the 138-day moving average. Price, for the most part, is above all of the moving averages, and the slopes are up. It's really the polar opposite, for the most part, of what we have in here. We're morphing into a full-bore bearish look, and then we morph back over to full-bore bull. And yes, moving averages are backward-looking, but the way that we handle that is use different moving averages that move at different speeds. So we're long-term investors. For the most part, the 8-day moving average is irrelevant to our day-to-day activities. But the action of the 8-day moving average relative to slower moving averages can be helpful at turning points and can be helpful for us in special situations. How about the 2009 case? It's relevant because in terms of the back-to-back-to-back 80% up days, this turned out to be a bad signal. There was a big loss after the third day. Thus, it would be prudent for us to try to build some type of model that helps us discern between the left side of the chart, where we have rally attempts here in 2008 into early 2009 that eventually fail, and this rally attempt after the March 9th, 2009 low that turned out to be successful. So here's your back-to-back-to-back 80% up day, in this case on the left side of the screen. Here's the first day here in 2008, the second day here, and the third day flips over into the new year. This day here is this signal date here. And you can see if we experience something similar in the present day from the date of the signal, this is how painful a move like that would be hypothetically. Using another anecdotal example of something that's different on the failed rally attempt relative to the successful attempt. See here, price cannot clear and hold above the 73-day moving average shown in orange. And the slope of the 73 during this entire period here remains down. But after the major low here on March 9th of 2009, price can check both of those boxes. It clears the 73 in this area here, and the slope of it turns up soon thereafter. You can see here, this looks a lot more like a full-bore bearish look over here from a trend perspective. And we get over here, you can start to visualize that shift back to a full-bore bullish look. And the concepts are the same no matter what moving averages you use. You can use short-term or much faster moving averages all the way out to quarterly charts. The concepts are identical. It's an example of markets moving in fractals. So we can see here that the back-to-back-to-back 80% up days aren't necessarily infallible. And we could show examples of numerous signals that we have in hand, including this from CNBC here, 95% of S&P 500 stocks advancing. There's the source of the data here. The data shown only goes back to this period here, so we don't really know what happened back here. But this is a successful signal for the most part eventually in 2009. Good signal here in 2010, 2011, 2016, and the COVID low. So these are very, very similar to some of the dates that we've already covered with the DeMark signals. Many of them align with these signals here from the back-to-back-to-back 80% up days. And there's no shortage of reasons to keep an open mind about the low being in place and stocks rallying significantly over the coming quarters and years. Here's another example. Insider signals. It's a very, very good signal here in 1994. Good signal after the low in 1998. Excellent signal here in 2003. Very, very similar to some of our other signals. These didn't work out so well here. This is 2008, and this is late 2008 here. Walking forward from there, an excellent signal in 2010, an excellent signal 2011, 2016, and Christmas Eve area here, this low, very close to the proximity of this low. Almost received a signal here near the COVID low, and we have one in the present day. So once again, an excellent track record, but not immune to bad signals and or some very, very bad signals. And that's true of any signal. That's not a knock on any of these signals or methods. There's no method that's perfect. All of it, including this research here, and including the CCM market model, they speak to probabilities, the probability of good things happening relative to the probability of bad things happening. So we have a lot of overlapping signals, especially in the present day. In the present day, we have the back-to-back-to-back 80% up days. We have an insider buying signal, and we did get the 95% advancing signal. And as we've covered previously, we do have an active daily 913. For this column over here, we looked at all 4 major daily DeMark counts. And like any other signal, DeMark 913s, especially when the market's falling, are worth paying attention to, and they can be extremely helpful. But like any other signal or approach, system or model, including ours, they speak to probabilities. If we have an expectation that the market is going to rally 100% of the time when we get a 913, that's not a realistic expectation. So not surprisingly, DeMark 913 signals can occur within the context of a long-term downtrend. Here we get a 9 paired with a 13. This is September of 2008, and you can see the signal is negated in this area here. And while we had potential or probabilistic trend exhaustion in this area here, the trend was strong enough and it continued. Similar situation here. We've got another 13 here paired with this 9 here, and eventually the market takes a whole nother leg down. This signal here in March of 2009 turned out to be very, very helpful. And if you know DeMark, there's a lot of helpful things shown on this screen here. And like many of the methods we use, even if the market doesn't reverse when you have the 913 over here, you learn something about the trend when the signal is negated. So a 9 and 13 can help us with bullish probabilities and increasing bearish probabilities. As we mentioned last week, a 9 paired with a 13 is a setup. And really, all of these signals are setups. And using a diverse set of tools and systems to try to discern between failed setups and successful setups that eventually lead to a market reversal can help us better understand bull-bear probabilities. And yes, the market has rallied strongly and moved a long way. But if you know your market history, you know that's typical during a bear market. Here's the source of the next few slides that we're going to show up here where my cursor is. This is the Twitter handle here. 1973-74 bear market. You get huge counter-trend rallies, fully retraced. Big counter-trend rally, fully retraced. And a big rally here where a lot of this move was retraced. Similar situation here, 1980 to 1982. Big rallies don't necessarily mean it's over. These are all downtrends. These are counter-trend moves within the context of an existing downtrend. Similar situation, 2000 to 2003. And the concern for us is, if you're not careful, and if you're not disciplined, you can get whipsawed out of your mind for very, very long periods of time. So like the CCM market model, our task is to try to discern between volatility to ignore and volatility to respect, in this case a counter-trend move that turns out to be a new bullish rally. So in the present day, until proven otherwise, any rally is a counter-trend rally within the context of an existing downtrend. Similar situation here. Financial crisis. We get massive counter-trend moves, fully retraced. Big move here, fully retraced. Big move here, fully retraced. If you know your market history, you know a lot of these signals shown on the screen here turned out to be excellent long-term buying opportunities. Not all of them. And some of the ones that were wrong in a big way. and some of them that turned out to be inaccurate probabilistic signals, there was significant pain after the signal. So again, that's not a knock on the approach. No tool, signal, or approach is perfect in the markets. And since some recent breadth signals that have previously been very, very helpful in recent years have not been particularly helpful in this calendar year, we decided to add another special situation tool to our toolkit. Top of the screen, CCM Market Pivot Rally Attempt Model asks and answers 363 binary questions regarding failed rally attempts, bear markets, and major stock market lows in 1967, 1970, 84, 94, 98, 01, 03, 08, 09, 10, 11, 16, 18, and 2020. From a moving average perspective, it uses moving averages from the 8-day all the way out to the 250-day. These examples here, 8-day all the way out to the 138-day. And the utility of many of these models and systems is it allows us to take a very, very large amount of data and boil it down to a single number. If you try to do all of this by flipping through charts and doing this in your head, you're going to be overwhelmed. Thus, it might be helpful to ask and answer. Out of the 363 binary questions, what percentage of the trend reversal hurdles have been cleared as of the close on Thursday, June 2nd, 2022? And the answer will always be somewhere between 0% and 100%. Answer? 6.65%. If you look at the 2022 chart in the center of your screen, and in these instances we're looking at the 8-day moving average in blue all the way out to the 250-day moving average in teal here, it's pretty easy to understand during the trading session on June 2nd that we really don't have a lot of improvement at this point. And even if we fast forward to the close, it's very, very difficult to look at this move here and say that it's really any different than this move here that eventually failed at this point. So far we have the 8-day moving average in blue turning up, 8-day moving average in blue turning up over here, and eventually this rally attempt failed. And we just now have the 21-day moving average shown in red ticking up slightly as of the close on June 2nd. So during the trading session, it was down or flat, and then by the close, because we had a strong rally into the close, it had ticked up fractionally. And in all of these cases, you can see conceptually, you have a full-bore bullish look over on the left side of the screen for the most part in every case. Eventually, you start to morph into something that's less desirable, and after a major low, just the opposite happens. If we're going to rally for several months, several quarters, or several years, we pretty much know with 100% certainty that the 8-day moving average, if the market's going to move in any meaningful way, is not going to remain below all of these moving averages here. You can see before this started, the 8-day moving average was above all of the moving averages, all the slopes were up, and for the most part, price stayed above them. So the purpose of the model is to try to discern between cases in these years here where we had good signals and cases where the signals were premature. And all of that will help us discern between volatility to ignore and eventually what becomes volatility to respect. Because volatility to respect is now it's starting to look like a trend reversal. And with a figure like this on even a very, very fast moving model, and a chart like this as of the close on Thursday, June 2nd, it's very, very difficult to say that we have evidence in hand telling us that right now this is anything in its present form other than a counter-trend move within the context of an existing downtrend. A CCM market model has several sub-models, and I can tell you most of them are much longer term because we're longer term investors. So you might imagine if this model is at 6.65%, the submodels within the CCM market model, for the most part, at this point, look worse. Is it possible that these numbers are going to improve significantly in the coming days and weeks? Absolutely, positively, yes. And the higher these numbers get, the higher the probability that many of these signals that have been incredibly helpful in the past in certain instances will be helpful again. Our models are telling us to keep an open mind about a wide range of outcomes, but they're also telling us to make sure that we don't get caught up in a counter-trend move. Here's another source of data. Here's the Twitter handle here. This tweet was after the close on June 2nd. The conclusion basically is, really haven't checked any boxes as of the close on Thursday that say a new bull market has been reborn. And like any other model, including our models, all of this just speaks to odds. Every single one of these boxes here could flip over to yes in the coming days and weeks. That may happen very, very soon. Hadn't happened as of June 2nd. And the S&P 500 chart as of June 2nd may morph into a full-bore bullish look and revert back to an uptrend very, very soon. It just hasn't happened yet. And if the signals that we have in hand turn out to be meaningful and the Fed has pivoted in some meaningful way, or something from a fundamental perspective has been baked into the cake and the markets are ready to resume an uptrend, then we pretty much know with 100% certainty this will not be the number that we're showing on this screen in the days, weeks, and months ahead. And when you're using the 8-day, the 21-day, the 34-day, the 47-day, the 60-day, etc., you can see a lot of these moving averages can change direction and flip up very, very quickly. And that's the purpose of all of this, trying to get a better understanding of how seriously we should take these setups that we have in hand. You can pause your video player here. These are some PowerPoint slides used in a presentation by James Bullard of the Federal Reserve Bank of St. Louis. U.S. inflation expectations could become unmoored without credible Fed action, possibly leading to a new regime of high inflation and volatile real economic performance. The Fed has a statutory mandate to provide stable prices for the U.S. economy. U.S. inflation in the present day is comparable to levels seen in the 1970s. And if you run J.P. Morgan or you run Goldman Sachs, you don't have a crystal ball either. But what they do have, the leaders of these firms, is experience. They've seen a lot. President of Goldman Sachs this week, this is among, if not the most complex, dynamic environment I've ever seen in my career. The confluence of the number of shocks to the system, to me, is unprecedented. You take the known problems that we have in the present day, and right now we have an established downtrend until proven otherwise. Back to Friday, June 3rd. As we've covered via these slides, we know counter-trend rallies within the context of a bear market can be extremely strong. And on the bullish end of the spectrum, we also know that we have numerous signals and data sets telling us to keep an open mind about much better than expected outcomes over the next few years. Our score that we covered Thursday night was 6.65%. When we rescored it during Friday's session, not a lot of change, down to 4.43%. And it should be noted that if we look at something like the 73-day moving average in isolation, it's not particularly helpful. But when we use a broad-based approach, using multiple moving averages on multiple time frames, the weight of the evidence can be extremely helpful. And as we've mentioned many times in these videos, there's always another side. The only question of is how long will it take and how much pain will there be between point A and point B before we get to the other side. All of these periods here are tied to 2022 in some way. And while things aren't going particularly well now, this is what happened after the major lows on the other side. Average gain from the low 1 year later, about 37%, 2 years later, roughly 60%, 3 years later, over 70%. And once the final low was hit, you really didn't look back in any case. Looking out even a year, your drawdowns were zero. As we've noted, it's the market's job to determine whether the Fed has pivoted in any meaningful way. We've been skeptical about that, but open-minded relative to the signals that we have in hand. If you want to get a good handle on the state of monetary policy, typically listen to what the chairman is saying. Now, this quote here from May 17th does not sound like a chairman that's ready to pivot just yet. And as we mentioned earlier in the year, we're dealing with a different animal in the Fed, different from really anything that any of us know looking back maybe as long as 20 years. The Fed's primary job right now is to deal with inflation. Protecting markets and protecting portfolios is second on the list, and it's a distant second. In fact, if the markets were to go up significantly, it makes the Fed's job harder. They want to see credit spreads widen. They want to see financial conditions tighten. They want to make it harder to get a loan. They're trying to slow things down. We really don't have any evidence in hand that tells us inflation is cooling in a meaningful way yet. You can find these comments on our Twitter feed. It's a little bit of a recap of what Powell said on May 17th. It's all relevant. And as we surmised last week, we said it was possible that the Fed would come in this week and walk back some of the dovish comments. Earlier this week, Raphael Bostic came out and said the idea of a September pause isn't tied to any kind of put for the stock market. The final portion of this week's video is being recorded around 1:45 or 1:45 p.m. Eastern Time on Friday, June 3rd. The S&P 500 is down 65 points intraday, and it's down about 45 points for the week. Thus, the measured bullet points from last week's video still apply. It's extremely important for us to keep in mind DeMark counts and breadth thrusts and other signals are setups. Setups help us pay attention with an open mind, but ultimately we need follow-through. A week ago, the trends were down. This week, the stock market's down as of this recording, so not much has changed. This chart here is 12:46 p.m. on Friday, June 3rd. Now for us, under normal circumstances, the 21-day moving average isn't particularly relevant. But if the longer-term trends are going to flip, the shorter-term trends need to flip first. So as of the close on June 2nd, after the 75-point rise in the market on Thursday, you can see the 21-day moving average here is flattening out and trying to turn up. During Friday's session, we don't even have the 21-day moving average signaling a possible shift in trend. We don't have anything in hand over here, and these are still relatively fast moving averages for our time frame. This is the 138-day moving average here. Everything else would be faster. All of those slopes are down for the most part. Only the 8-day has made any kind of move, but as you can see here, it doesn't necessarily mean a whole lot relative to the primary trend. So as we stated near the open in this week's video, last week's video, all of the comments, all of the concepts, all of it still applies, including something that we all know. None of this works unless we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.